is Lisa Snyder. I am the co-creator of Toketivity, a cannabis community for women. Today we have Sara Batterby on our classroom. We're going to be learning about fundraising for your startup. Sara Batterby is the principal of the Batterby Group. She spent 20 years launching and building companies in high-growth emerging markets. She's also designed and co-founded an angel fund in Silicon Valley to deliver a more data-driven and disciplined approach to early-stage investing. So I'd like to welcome Sara Batterby to the classroom today with Courting Angels, raising money for your startup. Welcome.
Hey, how are you doing? It's lovely to be here.
Yeah, it's great to have you with us. I am going to be silent here unless I am needed, so I'm going to let you sort of take the reins and hop off, and we'll just get this party started.
Yeah, awesome. Let's go. Yeah, so just to give you an idea of what success means for me, pretty much everyone I've worked with has successfully raised money for their startups. They've done it using about 80%, 20% of the time that it takes most founders who, you know, everyone knows fundraising is hard and everyone thinks it can take over your life, and it doesn't have to. So we try to do it in a way that is really efficient for founders. And more than 50% of the companies that I work with have been oversubscribed, which means that they raised more money than they needed. So that's really, really great news. And let's go ahead and find out a little bit about how I managed that. All right. So raising money for your startup, you'll see that I talk about it being an art and a science. And it is. And the reason that, you know, I'm doing this is just a long background. I've been in startups for over 20 years. I really have spent my whole career in startups, mostly in tech and in finance. And then at the end of that, I was living in the Bay Area and I was asked to come in as a partner in an angel fund. I built the first real data-based portfolio strategy designed to invest specifically in female founders and understand the benefits of female entrepreneurs. And we're talking about, statistically speaking, so real metrics about how female founders are a really great investment. And that was a really exciting thing to do. And one of the things that happened during that year was I had the opportunity to absorb a very sort of investor mindset. I stopped looking at everything as if I was a founder and started looking at the world through the eyes of an investor and really understanding risk and due diligence and how to do that kind of analysis. So with that understanding and combining that with everything I knew about startups, I came to Oregon and sort of accidentally found myself in the cannabis industry, which was packed with founders and startups, but a very different community of founders than I was used to in the Bay Area. These were people who did not have networking with investors as part of their regular work schedule. They hadn't maybe sort of done a couple of startups already. These were people who were doing this for the first time and entering a legal industry after maybe being participants in the gray market, where the things that you need to be good at fundraising, like record keeping and financial controls and all of these things, they just were the absolute opposite of what people were doing to be safe and run their businesses out of sight. And so this community of founders really, really needed some help. And, you know, when I led the race for Hi-Fi Farms and was very successful in doing that, people started to reach out and ask me what I was doing and why it was working. And it was interesting because I had never really thought about that. I'd been so immersed in the early stage investing world that this was something I just was doing on automatic pilot. So that was the first time I really had to think about what I was doing and why it was different and why it was working. And that was the first step really 3 years ago in codifying this methodology. And I gave a presentation at the Women Grow Leadership Summit back in early 2016 called The Feminine Art of Fundraising. And what I did was I related the work that I was doing to things that women are just innately and intuitively very good at. I really felt that my being a woman and certain things that I did that seemed very different to a lot of the stories that I heard about the way guys were doing things in fundraising was really what was making the difference. And so I decided to build a methodology around that. It was really, really important to me to democratize access to capital. 97% of venture capital money goes to men. And that's a couple of things. First of all, it's grossly unfair. But secondly, it really hurts investors. It means that there's not a real meritocracy in place and they're not really getting access to the best deals. And so I wanted to do something about that. And I came up with the Courting Angels methodology in order to fix it. So like I said, fundraising is both an art and a science. I think it's really important that you receive a whole bunch of tactical tools and understand the preparation, cohort capital, which I'll explain in a moment, how to make a really competent presentation, how to layer onto that a really strategic communication strategy, and how to effectively close capital. But the other side of this, and this is the area that I think gets left out of the conversations that support founders in raising money, is the sort of more emotional side of fundraising. I think of this as your mindset, your emotional preparation to raise money, sort of immersing you in this sort of mental state where this is your focus and this is the kind of thing on your plate, and it's almost the lens that you start to look at the world through. So random interactions are potentially, meetings with a potential investor or someone who can connect you with an investor, the way you structure your company, the way you talk about your company, all of those things become a part of how you are going to represent this opportunity to investors, all of these things. And the story that you tell. Stories are critical in early stage financing. Angel investors are taking a huge risk investing in your business. And the truth is, a lot of the time, what they're doing is they're making an emotional decision based on an experience of engaging with something that you are passionate about. And so while it's really important to be able to talk very succinctly and clearly about your product or your service, it's really important to give early stage investors access to your story and the sort of, the genesis of your idea. Like, where did all of this energy come from to create this amazing company that you're building? I think authenticity is critical. I think it's very, very hard for people to perform well in areas where they are not authentically being themselves. Your zone is always going to be in that place where you feel like you have the competence and the confidence to authentically be yourself performing in the task related to your company. And then confidence and trust. How do you build confidence and trust and basically be a hero in the raise process for your company? So preparation. Everything starts with preparation. And in the case of raising capital, it's 80% of the work associated with raising money. It's critically important that you create time and space. If you want to raise money and you decide you're going to go and start doing it tomorrow, depending on where you're at with your documentation and all the rest of it, you're a month or two away from really being able to have a competent conversation with investors if you want to be properly prepared for that process. And this is what I'm talking about for preparation. Let's talk a little bit about investors and how to understand them and how to get rid of some of the sort of urban legends that we seem to use that I think damage the way that we try to connect with them. First of all, the most important thing to notice is investors are not more important than you. They're not busier than you. Their time isn't more valuable than yours. It's absolutely critical that you understand that these people are equals. You're both professionals and you're looking to engage in an equal transaction on a level playing field. Another thing about investors at this very early stage, especially in the cannabis industry, is that they're anxious. They are generally not experts in the cannabis industry because there's really no such thing. There's really very little expertise in the angel investor community in cannabis because most of these people have made money in professional careers or being investors in other industries like technology and all the rest. And so it's likely that they feel insecure about the fact that they don't know very much about the business, even though they are planning to take a significant risk. So understanding that these people are people that you have to reassure and build confidence and trust in the relationship to resolve their concern and anxiety is very important. It's also really helpful to understand that they're less they're usually less scared of losing their money than they are of making a mistake that maybe is going to make them look stupid in front of their friends. Social capital to these people is probably as important, if not more important, than the little bit of money that they're going to invest out of their entire net worth, which is usually a very small fraction for people who are investors. They're really angel investing with just a tiny little slice of their assets, and their social capital is at stake, as well as their professional capital and their money capital. So it's helpful to know that, because understanding that about these guys, it really helps you get over any feelings of being intimidated or cowed by the process. It really helps you get onto that level playing field that's so important. Like I said, they really don't understand cannabis. You are the expert in this conversation. So take it upon yourself to play the role of a teacher, and we can talk a little bit about how you can do that. And also understand that investors have a lot of different reasons for wanting to be involved in startups. Startups are exciting, they're dynamic. Investors usually have some unspoken agenda with regards to an investment. Maybe they spent their life in a professional career as an attorney and feel like they missed out on the opportunity of being an entrepreneur. And that's something that they want to be involved in. They want to be involved in that exciting startup world. Or maybe they started a business earlier in their career, and they remember that feeling of being like hungry and driving really hard and doing the startup crazy hours and all of this stuff that happens in these young companies. And maybe they want to stay connected with that now that they're more sort of established financially. Another thing that's finally is important to understand is angel investments are usually relationship-based transactions. While it's critical that you build an incredibly competent presentation and an investor package, and then you are very professional in your communications, it's really also important to understand that what you're trying to build in the process of doing a due diligence process is a relationship that fosters enough trust and confidence and engagement and excitement on the part of the investor that they feel comfortable ultimately writing that check. So another part of the preparation, and we mentioned this earlier, this is what they really don't tell you in business school, but don't be shy about the personal. Like the reason why you started the business. It's such an important thing to share with potential investors. It will allow them to sort of engage empathetically with what it is you're doing and the place inside you that is where this vision is coming from and what's propelling you to be successful. The stories about why companies start are so much more interesting than the stories about what companies do. And it's just a fact. And stories really will drive a lot of activity in an angel round. So don't be scared of telling that. Reach out, contribute in your community. Building a profile around yourself and your business that is more than just you focused on your business and making money has a lot of very unique benefits. When I came to Portland, I founded the Portland chapter of Women Grow with a couple of other ladies in the industry. And it was a really valuable platform for us to build our credibility and build our community. And we did all of that with volunteer hours. And it took a lot of time. I mean, we were doing a lot of work to build a really amazing and dynamic community of women here in Portland at a time when we were all extremely busy building our startup companies at the same time. You know, there were days when I just thought, this is crazy. Why am I trying to do these two things at the same time? But what happened is that gave me a platform to build credibility and really showcase my skills around creating community and bringing people together and, and really, just making things happen. And investors want to see you and have the opportunity to see you performing in multiple different ways. If you're showing an investor a plan that is about something that you're going to do in the future, give them an opportunity to see some of the things that you're doing in the present by finding ways to contribute in your community that showcase your particular expertise or your talents. And invest in others. I've done so much work advising and mentoring other founders. And what that does is it basically creates a lot of goodwill. Again, it gives you an opportunity to do something in a visible way that puts you very much in your absolute zone. Like if you have the opportunity to look around you and, whatever your superhero power is, share that with somebody whose superhero power is something totally different, and do skills sharing. It's really a great way to build community, build credibility, and really showcase your skills, and then have that be visible to potential investors in your company. And the final thing is build intentional culture in your company. Businesses, especially startups, are like families. It's not very much fun to be around them if they're not, in harmony. So be really intentional about how you build your team and your culture in your company, because this is a place that the investor is going to sort of want to be welcomed into. And if it doesn't feel good to be in and around your company, an investor is going to feel that, and they're going to find somewhere else to put their money. So the other thing, this is very tactical. Preparation in terms of structure. There's a lot to talk about on this slide, and we'll sort of go over some of these things in other ways as we move through the presentation. But first of all, I want to talk about timing. Schedules are really important in business, and they're a great way to keep track of milestones and set goals and create accountability. And they do all of those things in fundraising. But they do something else in fundraising. Setting the schedule for your raise is what initially puts you in control of the process. Instead of it being a situation where you're running after one investor down one lane and you're running after another investor down another, and they're in different places in the process, and there's communications going back and forth individually. If you start having to do that with 10, 20, 30 people, your life is going to be very, very jumbled and confusing. You need to create a schedule in your raise, and the schedule is as follows. You go through, you take a look at where you're at with your business and your preparation, and you set a date to open your raise at some point in the future. Then you open your raise when that date comes. And then the next date from there is when you reach out to the investors that you have in due diligence and you gather commitments. And then there's another date where you solidify those commitments. And then there's a final date where you call capital. And sometime after that, you'll close your raise. That is a raise schedule. And it's very, very important to establish one up front and stick to it. Well, the question is how do you get all of these individual investors with their own schedules and their own different communication styles and everything? How do you get them all onto this schedule? That's a couple of things. First of all, it's really creating a very protected and gated format for the due diligence. If there's one thing that you take away from this presentation, this is it. Never attach emails, never attach your investment documents to emails and send them to investors. You probably will be in this conversation many times. You meet someone who's a potential investor, and they say, oh, that's great, you're raising money. Send me your stuff. And you go home and you send them the email, and you send them your stuff. You attach your business plan or your pro forma, and then what? Mostly what happens is you just sit there and wait. Now think about this. This is a relationship that you've spoken to someone for maybe a minute or two. You've sent them your stuff. There's really no relationship there. You're on one side of that relationship feeling anxious and powerless while you wait for them to respond. And they're on the other side of that relationship with your stuff in their inbox. Well, that's not great, because ultimately they've said that they're interested in your stuff, so they feel a certain degree of obligation to look at it, but you're not a priority because there really isn't a relationship there, and they're going to start feeling guilty. But the way that they're more likely to interpret that experience is through a feeling of annoyance. So you're anxious, they're guilty or annoyed, and what tends to happen is founders have the experience of just being ghosted, where an investor just disappears. And often I think what's happening in that interaction is the relationship broke. It broke under the pressure of you giving them a to-do list before really engendering a degree of engagement that supports them investing their time in getting to know you. So let me tell you about how that conversation should go. If you're at an event and you meet someone who's a potential investor in your company, you say, they'll say, hey, send me your stuff. And you say, actually, I really like to start this process with a conversation. And maybe if you have time, we can schedule half an hour to sit down and have a cup of coffee or get on the phone. And I can tell you a little bit about my company and how we got to where we are and give you a sense of the big picture plan. And I can get to know you a little bit and see if there's a fit. And we're in the process of preparing for a very professional capital raise. And we're planning on opening our raise on some date in the future. And if it seems like there's a fit, it would be, I'd be delighted to invite you into the due diligence process. Now, by having that conversation with a prospective investor, you're doing some really interesting things. First of all, you're making it really clear to them that you're going to qualify your investors. Not anybody is just going to come in and look at all of this work you've done in your investment package. You're going to be selective and you're going to qualify these people. You're going to make sure that these people are a fit. Another thing is it immediately puts this investor onto your schedule, which means you are now in the driving seat. And at the same time, you haven't asked them for anything except 30 minutes of their time to talk to you and get to know you. And the bottom line is if they are not at a level of interest where they have 30 minutes to talk to you, then you're never going to elicit the engagement that you need from these people. And it's really a waste of your time to invest a whole bunch of email and communication time trying to get them to respond to you. So it's a great way to filter out looky-loos and people who aren't very serious or haven't really, felt that jolt of excitement hearing you talk about the opportunity. It's a very easy thing to say yes to. It's an invitation into a due diligence process that starts at some point in the future. Most investors will say yes to that. So make sure that you establish that format for communication and do not navigate away from it, really for any reason. And so in order to make that work, when you come to your date for your due diligence to open, when you're opening your raise, where are you inviting these investors to? So what you're going to do is you're going to invite them into your investor folder, and that is going to be a data box, like a shared folder in Google Drive with a series of subfolders that have these elements that you see on this slide. You're going to have you're going to have a folder called, the Batterby Group investment folder. And then under that, you're going to have your incorporation documentation. You can't raise money if you don't have a legal entity to exchange equity out of. Your investment instrument, is this a SAFE? Are you going to use a SAFE agreement, a convertible note? Is this an equity raise? Are you going to do a debt raise? Your executive summary and business plan, basically your company information, is going to be in this folder. Your financial information is going to be in this folder. That's where your pro forma is. And a pitch deck, it's okay to have a pitch deck, but you're really not going to use it in this particular fundraising process. A lot of founders, or some founders, are very visual people, and they feel organized through the process of creating a pitch deck and having that really be a polished piece of their presentation. And if that's the case, I would say go ahead and make one, drop it in your company folder, in your investment package, and let it sit there. I don't use pitch decks in conversations with investors because mostly what it does is it gets in the way of your primary objective, which is creating a relationship with that investor. So these are some of the things that you need to be prepared for in terms of the structure and the format and the timing of this raise. So preparation, your cohort. Effective fundraising is a team sport. What's really important to understand about this fundraising process is one of its goals is to gather your investors together into a group, and I call that a cohort. The reason that we do that is because people behave differently in groups than they do individually. If there's a lot of people around your raise, or let's say you've done a great job of inviting people into your due diligence process, and you've got 10 people who have agreed to be in your due diligence process. If those people are aware of one another and can sort of identify as a group of investors around your company, they're going to behave differently than they would if it's just a one-on-one conversation between you and them. They're going to start assuming the behaviors of a group. That means they're going to have a higher degree of tolerance for risk because they feel like they can be peer validated by the other people around your company. They're going to experience a lot of confidence from seeing other people who are excited about the opportunity. And they're also going to have this sense that you've done a really great and professional job of building interest around this capital raise, and you basically may not need all of the investors that are in the group. So they're going to have a sense of scarcity and maybe even a little bit of fear of missing out. That's going to really encourage and motivate them to be timely in communications and stay on schedule and all of these things that are going to allow you to move these people together through the cohort, through the raise. And the thing is like, the next question is, so who's in this cohort? In my experience, whether founders know it or not, they've already done the fundamental work of building a community around their business, which is a place where they're going to be able to raise capital. It's really just a matter of looking at your network through a different set of eyes. And what we did when I came to Oregon and started a company was we pulled the founders into a room and we basically thought about what we were doing and thought about who we knew who might be interested in investing us. So we made a list of people and we put it on a whiteboard. And we reached out to those people and asked them if they were interested in being invited into our due diligence process when we opened our raise. And they said, yeah. And that was awesome. And we also did another thing. We asked them if, because there was a lot of activity and changes in the rules and everything was very volatile and dynamic at that time, I said, rather than try to keep you updated individually with all of the different things that are going on, I'm going to create a group email and I'm going to include in it all of the people who are in the due diligence process and invited into this very selective process. And I'm going to communicate with those people as a group. And I got the permission of the people who were in the due diligence process to do that. And by doing that, what I did was I created a mechanism that moved these people from the individual dynamic into the group dynamic. And I set up a communication strategy that I could start using even before I opened the raise. So if you have your raise scheduled for 30 days out, you can start communicating with this group with industry updates. You can start demonstrating your knowledge of the industry. Maybe that you got an article written about your company. You can start demonstrating all of these interesting things, milestones within your team, successes, all of these things that are happening in your business and in your industry. You can start communicating to this group even before you open your raise and give them access to all of the documentation in your investor folder. You're going to start building engagement and trust. And in a lot of cases with the clients that I have, they will start to get capital commitments even before they open their raise as a function of deploying this strategy. It's really, really effective. So what's really important is you figure out who you want to qualify into your investment due diligence process, and then you get them to agree to this group format for communication. And there's only been one occasion when an investor for one of my clients said they didn't want to do that, and they just moved them into the BCC line of the email. So they still saw the group, but their email wasn't visible to the other people in it. So this is really interesting. It's a really interesting psychodynamic, and you'll feel the shift. And you also are demonstrating as a founder a huge amount of confidence by making it possible for investors to ask you questions in a group format. A lot of founders feel scared that an investor who asks a question about one risk is going to scare off a bunch of other investors who hadn't thought of that risk. That does not happen. It's really beneficial to you to let these people know about each other. They'll probably never speak to each other, and maybe they will, and maybe they'll end up working with you more closely in the company. But just the fact that they know they're in this group format changes the dynamic of the entire raise. So communication, this is really, really the strategic part of this raise. And I'm going to reiterate a couple of things. Always start this process with a conversation. Insist that someone gives you a little bit of their time. That does a couple of things. You guys really get to know each other and you can decide if this person's a fit for your company. But secondly, by having that conversation, you change the nature of the relationship and you increases people's sense of personal responsibility around doing things like responding to emails and spending time looking at your materials. People will feel more accountable to you in this process if they've got to know you a little bit. You do your, you basically, there is a case where sometimes I send a very, very high level overview of the something called a financial narrative, which is a very high level overview of the financial past, present, and future of your business. And then basically schedule a meeting and chat with them. Get permission for this group communication strategy and then use it to update people. Do not spam these people, they are busy. One email a week is plenty. There will be periods of at least usually a couple of months of preparation leading up to opening your raise, and then a period of engagement and due diligence after you open your raise and before you gather commitments that allows you to build this engagement strategy. So you'll have 6 weeks or 8 weeks to send out these emails and get the engagement. And then leverage your cohort to build credibility and appetite. If you get a commitment from somebody in your cohort, it's perfectly appropriate to send an email out to the group and say, hey, great news. Today we received our first commitment for $100,000. We're super excited. We are not yet ready to call capital, but we really, really appreciate these early signals of support and interest in our company. You can, constantly doing this engagement thing and letting these investors in this group know that people are excited, people are interested. And then you reach out specifically. Maybe it's 4 weeks after you open your raise, maybe it's 6 weeks, maybe it's 8 weeks. It really depends on a number of factors, how big your raise is, the number of people in your cohort. But at some point, you're going to reach out individually and you're going to ask for a commitment. That's how much money are you planning on investing in my company? And when will you have that money available? Is that available today, or are you waiting for that money to come out of something else? I would do this by picking up the phone. People don't do that anymore. But in a situation like this where you really don't want to send an email and be waiting for an answer, you just need to pick up the phone to have these conversations. And take notice of the fact that you never ask for money. You don't call and say, hey, are you thinking about investing in my company? These people are in this process with you now, and there should be a degree of engagement when you ask for commitments that you can reach out and confidently just ask people to give you the number that they're thinking of as an expression of their interest. And then the final thing is, don't rush. You're going to get signals from investors saying, I'm ready to send you a check right now. I'm ready to go. Just say, you know what, I'm really committed to following this process. I want to follow the schedule so I can really be smart about how I organize my cap table. And thank you so much. And as soon as we're organized around our commitments, we'll be sending you out the documents to call capital and close the raise. So here's something that is really, really powerful also and helpful. What's really, really going to make a big difference in terms of how people trust you in this process are the extent to which you held their interests in mind. And one thing that founders are not in the habit of doing is really thinking about their company from the perspective of the investor and thinking about how they can create protections to cover that investor. And here are some examples of investor protections that you can apply to your company. Cap salaries, it's a really great, usually it's somewhat of a gesture. The thing that's going to cap your salaries is probably reality, as we've all learned as we've got into this industry. But it's nice to say to investors, as part of your investor protections in your investment documents or in your shareholders agreement or operating agreement, that you're going to mark your corporate, your executive and founder salaries. They're going to be market salaries. You're not going to just pay yourself as much money out of the company as you have and degrade the position of the investors. Founders' equity. If you have a lot of founders in a company, 2 or 3, it's really worth having all the founders be on a vesting schedule for a portion of their equity, so that if for some reason it doesn't work out, it's going to take you 3 to 5 years to build this company. If for some reason it doesn't work out with one of the founders, the investors don't have the problem of seeing one of the original founders walk out of the door with 25% of the company, which is really going to degrade their value because that person isn't adding value to the company in, say, year 2, 3, and 4. So really think about founders' equity and how to protect yourself and make it so that as long as you're there and as long as you're adding value as a founder, you're going to be earning that equity. But if you decide you want to leave, or if there's a failure in performance, the company has the right to bring that equity back and reverse dilute the investors. Governance. even though you're in a tiny little company and you haven't raised money yet, you still need governance. You still need to some degree, a board of directors, even if it's just a matter of adding one person to the board. So you have 3 people. It's really critical that there's a governance structure that can break a tie break if there's a disagreement within a 2-founder management team or something like that. And it's a really strong signal to investors that you're prepared to be accountable for your own performance as a founder. Commitments. If you have commitments from investors from the past, or people have already shown a financial interest in your company, you can use those to sort of provide reassurance to investors who maybe are less experienced. Sophisticated investors give your company a lot of credibility, and they actually act like a protection to less sophisticated investors. And then there's the sort of nuts and bolts, things like D&O insurance and things that let someone know that you've thought about the legal liability in relation to the company. That's directors and officers insurance, and it covers all of the directors and officers of the company from any legal liability related to anything that you're doing. And that's maybe particularly important in the cannabis industry. And this is a little bit more about your preparation in terms of competence. It's important that you are a total expert on your business, but you also really need to understand your industry. Cannabis is a emerging market commodity. It has certain characteristics, and it's really critical that you understand them so that you can anticipate trends and changes that are going to happen and that are coming your way, regardless of how good you are at running your company. And in cannabis, here's what you can expect: price volatility, the cost of regulation, commoditization, emerging brands, and mainstreaming. These are all dynamics that are going to affect you. They're going to impact your revenue and your costs. And you need to understand these. It's not enough to be just an expert on your company. And finally, closing capital. So you have your cohort of investors. They've been invited into your raise. You've established and maintained this really engaging format for communicating with them throughout. You've gathered your capital commitments. You've structured your cap table, which shows how ownership works in your company. And now you're going to call capital. Closing is one of those things that I feel conflicted about talking about, because I just don't think it's really a thing. By the time you get to the point with these, it's time to call capital, relationship with them, that really is sending very clear signals as to whether or not these people are going to invest in your company. And the truth about this process is that people who are not interested in investing in your company will self-select out of this process. So you'll always know that if someone's still in that folder and still being somewhat responsive, and if they've been willing to pick up the phone when you called them about making a commitment, then these people are likely at this point going to invest in your company. They've had an opportunity to see your management. They've had an opportunity to witness your management style, how you manage challenges, because you've been sending these updates. Even if you have a problem or need to ask a question, put it out there to these investors in due diligence. The minute you engage them in solving problems in your company, they will definitely invest in your company. And just really, you've sent a lot of really strong signals about your confidence, your strength as a founder and a manager, your ability to lead a really key professional task like fundraising and do it retaining total control over the schedule and the structure. All of these things are really, really going to motivate a lot of investors to close. And on average, in the raises that I work with, more than 80% of the investors who are invited into the due diligence process close. They write checks to the founders, which is why these raises are oversubscribed and why people raise this money in these short time frames and raise the money very closely together in one block, which is critical. There's nothing worse than raising $500,000 and having 100,000 come in and then waiting 2 months and having another 50 come in. That will kill your capital utilization, which means the value that you get out of that money. So it's a really powerful strategy for that. So keep your confidence, hold your space, assume the close, and simply ask people to conform to the schedule that you've established for calling capital. And keep your cohort together and steer them into this deal. And really, that is how to raise money. It's incredibly effective. It's a very, very relational way to do this, because your primary job and the thing that's really happening here is the creation of this relationship through this engagement strategy. And what's important to know there is that as women, I think we're intuitively really good at that. I think women who understand and use this particular approach to fundraising are phenomenally successful with it. And it's very exciting to see that happen. So that's a little bit about it. And if you feel like you want to learn more and get into more detail, again, I'm Sara Batterby. This is my contact information, and I do a masterclass, which is an 8-week program that teaches founders how to raise money for their startups. And feel free to reach out. There's information about it on the website, which is batterbygroup.com. And thank you so much. It's been great being here and sharing this with you today.
Yay, thank you so much. I think that you are so awesome, and you're definitely a very wise woman who, knows a lot more about finance and raising money than a lot of us do. And I think that empowering women at the root level is number one priority for us. And there's so many places to do that. I think that there's a lot to learn in regards to money and confidence around it. And I really appreciate you working to build up the confidence of women in their financial lives, which ends up playing out in all the other places. So thank you so much for your time today.
Yeah, thank you so much. It's a pleasure.